Well, welcome everybody to this first time for us doing a question and answer webinar live. We're excited about that. We've already had several people text in or email in their questions. So we're going to address those first. So that gives you time that are here live on the meeting to get your questions either put in or raise your hand so that Michelle can call on you.
Yes, you can put your questions in the question box, or you can raise your hand if you want to speak it out. So we're looking forward to answering your questions. And one of the callers today asked me, what should I expect on this Ask Us Anything webinar? And I said, I'm not sure. We've never done one before. So we're looking forward to this next hour that we have together. And if you like it, we'd consider doing it again, wouldn't we?
We would, with one caveat. If you ask us a question we don't like, we don't have to answer it.
Okay. All right. Well, we're used to answering your questions, as you know, with phone calls, emails, even text messages. But this is a time to give just a little more answer, a little more detail. Of course, you often address questions on the podcast as well. And Gracine and Anna address them in the video of the week, answering questions. So we're always happy to listen to your questions and address them. And the benefit of being in a group too is sometimes someone asks a question that you didn't think of. And so you get to benefit from hearing that answer. And then sometimes that even stirs up other questions, thoughts, ideas that you may not have considered in the past.
And so many questions that we answer one-on-one, we just knew that a group would benefit from hearing that. Like Michelle said, if one person has the question, there's probably quite a few people that have the question too. And we thought doing this group session here, it would benefit more people at one time. So let's get started, Michelle. What's the first question that's out of the box?
Okay, well, I don't see anything in the question box yet. I don't see any hands raised yet. Actually, I'm not sure if I can see. Okay, yeah, I'm not seeing any hands raised. And you know what? I'm not sure if I'm going to. So, oh, there we go. Yep. Okay, so I don't see hands raised yet. But if you want to put a question in the question box, type it in, that's fine too. But right now, let's first go to Aubrey from Alabama has a couple of questions. The first one, I would like to know what effect interest rates have on the cash value of whole life policies.
So we have been in a low interest rate environment since really the dot-com bubble back in 2000, 2001. When that bubble popped, interest rates were lowered by the Fed, and they are just now starting to be starting to go up. The Federal Reserve banking system, the chairman is raising interest rates. We've already seen at least one rate increase this year. They're on record of saying they're hoping to get 3, maybe even 4 more interest rates risen in this calendar year. So when that happens, it it puts a damper on the entire economy. What insurance companies tend to do is they tend to lag behind what the market does.
Mm-hmm.
And the reason they do that is insurance companies are not investing in the hot and volatile markets. They're interested in investing in slow, steady growth, very much like Aesop's story of the tortoise and the hare.
Mm-hmm.
They want to be the slow tortoise out of the block, not risking a lot, because they have liabilities to pay for people that are buying life insurance. And when those people die, there's a mortality cost that they have to spend. So they have to be prepared for that. So when they're investing in bonds and commercial real estate primarily, and very, very few insurance companies that are mutually held even invest in stocks or mutual funds. So, and if they do, it might be less than 10% of their entire portfolio.
Mm-hmm.
So interest rates do affect policy growth. But remember that when Nelson Nash wrote his book, he was in interest rates that were 21% plus. And It was at that time that he was able to access money out of his policy between 5 and 8% to pay off what he called the snakes and dragon that he had borrowed money from to buy that commercial real estate. And what happened is that was the beginning of the infinite banking concept, because he said, my goodness, if I can help other people do this, then we need to help people understand that building cash values in a life insurance policy will be there for them when interest rates go crazy again.
So also when you were speaking there of policy loan interest, what do those rates look like? And of course, in the 80s, those interest rates were higher than what we're seeing for policy loans right now. Um, but when someone has guaranteed cash values, those are not changed by the interest rates going up or down. You have a guaranteed contract, and that's what it will be, regardless of what happens in the market.
That's true. Now, dividends could be affected
Mm-hmm.
because dividends are the profits an insurance company makes from year to year. And of course, if the insurance company is being able to earn a higher return on their bonds and their commercial real estate because of interest rates being different, then that could change in our dividend portfolio that is being paid and shared with us as policyholders.
Okay, and then Aubrey's question, his second question really is off that first one. Does it really matter if rates are low or even climbing?
Are we talking about what's happening in the policy, or whether we should borrow from the policy at that time?
Oh,
Let's
yeah, I'm
address
not
both of
exactly.
those.
Yeah, good idea.
So it really doesn't matter whether interest rates are low or high, because as Nelson said in his book, the policy is the tailwind that helps you accomplish more than what you could do without it. So if you and I are making the same investment or the same use of money, Aubrey, and you have a policy and I don't, you're going to do better overall than I am because I don't have that tailwind. Remember Nelson talking about getting in his airplane and flying to Chicago with a headwind, and he won't get there as fast as if he waited until that high pressure moved on and there was a change in the wind direction and he was able to go to Chicago with a tailwind. And that's exactly what the policy does. So if we'll build those cash values up, they're there. The growth in the policy, the dividends that the policy is going to earn as well, they're there to push us further than what we could do without it.
And so you're also touching on the environment, the financial environment that we're on has an effect on exactly how we handle our policies and what we do. The financial environment makes a difference on, how often we go to the store with gas prices, et cetera. You just make adjustments here and there based on what kind of financial environment you're in, just like the airplane in whatever kind of weather you're in has to make adjustments.
That's correct. Yes.
Okay, so let's see. We have a question from Jason from Washington. Hi, Jason. He says, "Hi, Tom and Michelle. If I can only afford a $5,000 a year premium towards a whole life policy, is that possible? Is it too little? Is it better based on our age, 47, to take out policies on our kids to use the cash value portion for us while building policies for them?"
So I was 45 before I ever heard about Nelson Nash. And so age, 47, that's only 2 years older than what I was when we started doing this. So first of all, to answer your question, your age does play a role in how quickly you can build up cash values. However, when we're looking at children and we're talking about minor children under 18, uh, they cannot get a preferred or above standard rating on their policies. So they already are paying more for their base insurance than what adults that have taken good care of themselves could possibly pay for their base insurance. Now, Mr. Nash used to talk about the selective process in forestry. You plant the forest and then you go through and you harvest the little trees out every 5 years, and pretty soon, 20 years down the road, you've got trees that are ready to harvest. So what that teaches us is that we should first insure ourselves, because our children can only have half the insurance on our life that we have on our own life.
On their life.
So then secondly, are we going to be able to build up more cash value in their policy for them versus how much death benefit we can build up in our policy for them when we pass? And then finally is which one is going to produce the most cash value so that we can begin to manage that? And if we manage it better, will that then give us the opportunity to buy the policies on our children that we want to and should if we can comfortably afford that? So that's the process that we go through.
So in answer to that question, it's almost always better to get that life insurance on yourself. Sometimes if someone is highly rated, then that's going to be a little different conversation, but most often it's better to get it on you before you start insuring your children. Is it a good idea to insure children? Absolutely. And we do that every day. We're working, helping people insure their children as well. But there are some guidelines for that, and it doesn't necessarily produce more cash value for you, and it won't necessarily protect the family like they need to be protected.
So Michelle, the second part of Jason's question was $5,000 enough to insure his life?
It's not, it is enough to start a policy. Is that enough to insure his life, provide for his family? Probably not. We're probably going to want to supplement. He may have some other whole life insurance, or we may be supplementing with some term just to make sure your family's taken care of. But 5,000 on a 47-year-old, yes, that will work.
But we always have to start where it's affordable and comfortable for you. Otherwise, it's a no-go.
Yes, and that 5,000 doesn't have to be paid all at once as an annual premium. It could be split out, divided by 12, paid as a monthly premium as well. Okay, so let's see. Here's someone else in Washington from Mark. With all this talk of inflation, in what ways does a life insurance policy give me protection?
Well, first of all, it only gives you protection if you own one.
For sure.
But Mr. Nash used to talk about this in his seminars to great lengths. And he would talk about the price of chicken and how chicken really hadn't gone up in price, like his wife Mary said, it had actually gone down in price. So inflation is a relative term, but we do know that inflation is when the Federal Reserve is printing more money or buying their own bonds back at a higher rate than putting more money into circulation. It's like diluting the value of our dollar. And I always tell people, if you took a glass of orange juice and you diluted it with 50% water, would it still be orange juice? The question about that
I don't
is,
want to drink it. Thank you.
the same question goes with a cucumber. If you put it in vinegar, when does it turn to be a pickle? You know, you've got to understand that. So Hal Nelson talked about how a life insurance policy protects against inflation is that the dollar that you are guaranteed to never pay more in premium today when you buy a policy is not going to be as valuable tomorrow because the Federal Reserve is diluting your dollar. But the dollar amount, if it's, $10,000 a year, is still going to be the same 20 years from now when you're paying that premium, even though it's not worth what $10,000 is today. And then secondly, because cash values rise to exceed the cost basis of your premiums, that's the second way that the policy hedges against inflation. And then thirdly, it's hedging against inflation because it multiplies the dollars that you are paying in premiums for a death benefit. And that's going to bless the next generation or whoever your beneficiary is by protecting them against inflation because it will always be more that they receive from you than what you could have saved on your own.
So that reminds me a little bit of Randy's question. Randy from Louisiana sent his in ahead of time. He said, future life insurance proceeds from participating whole life policies will be paid out in US dollars. These dollars are depreciating at a currently stated government rate of 8 to 5%. I think most of us realize the real inflation rate is more like 13 to 18%. Why should someone put funds into participating whole life insurance instead of precious metals, given that historically precious metals have performed better in keeping up with inflation and protecting purchasing power better than dollar-denominated assets?
So the answer to that question is, again, straight from Nelson Nash, is that gold is being treated as a commodity in our society today. It's not a currency. And to be able to spend your gold, you have to convert it to a currency that is accepted on the market. So in very few cases, you could still barter with gold or exchange your gold bars or coins with someone else. But typically you have to convert that commodity into a currency. And so when you do that, what currency is it? Right now it's US dollars. In the future, it might be some type of crypto. We don't know. But the thing is that the American currency that has been used in the United States has changed over the years. Um, Initially, it was the continental, you know, and the term came around that it's not worth a continental because the continental got inflated so much by the, the the colonists that it wasn't worth anything, so they switched and they went back to gold and silver and precious metals being a currency. Then later on, during our Civil War, silver was what coming out in Nevada and some other places was what really helped the Union win that war. But then shortly after Lincoln was shot, silver was demonetized in the United States. All those silver certificates that was printed during the Civil War, what were they worth? You couldn't use them for money anymore. And of course, the Confederate dollars weren't worth anything after that war was finished. So we've seen this happen time and time again. FDR in 1933 banned gold, even the ownership of gold. What's happened in the past could happen in the future. We don't know, but we do know this, that life insurance is a contract that guarantees a certain, right now, US currency for whatever US currency you've paid into it. And unless the, the contractual law that binds America together is completely obliterated, then when a life insurance pays out and we're on a different currency, then it should be paid in whatever currency we're using at that time, equivalently.
And I don't want to rabbit hole, but I remember just recently you were talking about how um, people were required to turn in their gold for much less than it was worth, like $20 an ounce rather than like $67 an ounce.
So
When was
yeah,
that?
so FDR banned the private ownership of gold in 1933, shortly after he took office with an executive order. And what he did is everyone had to turn in their gold, and they got like $20.56, or maybe it was $22.56. I can't remember exactly, when they could have sold their gold on the open market internationally for $35.
Yeah.
And if they didn't turn their gold in and redeem it at that $20 value, they were fined $10,000 and could spend 10 years in prison for it.
Yeah.
So what we're seeing today is high inflation rates, much like the Nixon Carter administration stimulated. And then along uh, along came Paul Volcker, and he raised interest rates to fight the inflation because that's the way the Federal Reserve fights inflation. They basically dry up the money supply so it decreases demand, and therefore it cuts inflation down. And so what happened is Paul Volcker raised these interest rates to 21% prime. So if you're borrowing money that, you're going to pay 21% plus. And I remember at that time, a colleague of mine in school was delighted to get an adjustable rate mortgage on his first house at 17%.
Yeah.
Okay, so it did bring inflation down. Ronald Reagan came in, and they repeated the cycle with the new Fed chairman. They drove inflation again. These are cycles that occur all the time in history, and we just have to realize that life insurance has been able to overcome these obstacles for over 100
Mm-hmm.
years. Some of the companies we work with have been doing it for over 120, 130 years. And that's why we are so keen on using the life insurance policy to bring some stability about in our life.
Right. So that he mentioned historically precious metals have performed better in keeping up with inflation? Better than what and at what time? Because I know a number of years ago we bought silver and with the anticipation, oh, it's going to get greater in value, and it plummeted.
And we've never been able to sell it for what we
No,
bought it for.
so we've got some
Okay.
silver sitting around, and we know for sure that every single person is going to die. And so when we plan around that known event, there will be a payout at that time. You could have gold and try to cash it out when someone dies, and it might be the wrong time to cash it out, and you could take a loss. So the life insurance provides a guarantee.
Yeah, and gold stayed at that price that FDR froze it at until 1971, when President Nixon signed another executive order shortly after he was in office to take us out of the Bretton Woods Agreement, which then allowed the gold to fluctuate. But it's tied with what the value of the US dollar is still yet. It's not that gold has increased in value, because if we look clear back to the Roman times, a 1 ounce of gold would have bought a nice man's suit of clothing back in Roman history, and one nice gold coin today could buy a very nice man's suit of clothing today. So gold has not inflated. Gold has not increased or decreased in value. It's a stable currency, and that's why ideally we should have our currency tied to something stable like gold and silver.
All right, and then Randy has a follow-up question. If cash value in a policy is growing at 4 to 6% and inflation is 12%, then future purchasing power of the life insurance proceeds is being reduced rapidly.
Yes, but not as rapidly as your dollar, because your dollar saved in a tin can or a bank isn't even earning that amount.
That's right. And people could try to argue with us, hey, investments, though, you could get this or that. Well, maybe you're not guaranteed that. And with a life insurance policy, you're always guaranteed.
Plus, we're taking out the banking equation, and so many people are looking at the
Mm-hmm.
policy as their bank. And Nelson Nash would turn over in his grave if he understood what people are doing. The policy is not your bank, it is your depositor. It is like building a reservoir of money that is going to authorize you to use someone else's money. We live right here near Hoover Dam, and that dam was started in the 1930s under the Hoover administration, and it took 5 years after that dam was completed before it was filled up. Now, it didn't take that long before Hoover Dam started generating power, but before it filled up, it was 5 full years. And so people are starting these policies and they're thinking that they're going to be completely full when they first start them. And that's not the case. It's going to be a lifetime endeavor for you to
Mm-hmm.
fill your financial reservoir. And that's what the policy does. It gives you then the power to collateralize your financial reservoir or cash value to then use the insurance company's money.
Mm-hmm.
And using the insurance company's money to make other investments while your policy is still getting the low growth, even though it might not be keeping up with inflation, it's still a tailwind, it's still power in your pocket. And combined with what you can do with the insurance company money on loan, you can overcome the inflation if you are wise and a good money manager.
All right. We're going to have a question from Gilbert in Arizona. He has a couple questions here, and I'm really glad that I'm going to get a report of these questions because I'm going to follow up in an email with some more details on this. But he's asking, how do paid up additions affect the infinite banking?
How do what?
Paid up additions. So he's talking about the paid up additions rider that you attach
Mhm.
to a life insurance policy.
Sure.
How does it affect infinite banking?
Okay, so let's look here. When we buy a whole life insurance policy, there's two types of insurance that are going to be in that policy. There's going to be base insurance and there's going to be paid up insurance. And the base insurance up here is going to, over time, convert to paid up insurance. Paid up insurance is insurance you never pay another dime of premium on. It's yours.
Mm-hmm.
You own it. It's like the equity in a mortgage. As you slowly pay the mortgage down, the mortgage shifts from being owned by the mortgage company to being owned by you.
Mm-hmm.
Now, that's just what happens in a typical whole life policy. What Nelson Nash came along and said is, wait a second, The IRS only requires this amount of base insurance to be qualified as a life insurance policy. And you can take the extra premium you want to pay into this policy and it can buy paid up additions. That's in the form of the rider. So some people
Mm-hmm.
call it a paid up rider, some people call it paid up insurance, some people say it's overfunding, some people call it flexible, paid up rider. There's all kinds of names for this paid up additional insurance that you're buying on top of the base insurance. This paid up insurance rider immediately produces cash value for you. You don't have to wait for it to trickle down from base insurance to paid up insurance. And so the IRS regulates how much can go into this base insurance policy before that policy would become taxable. So that follows the IRC code 7702,
Mm-hmm.
and that defines what a modified endowment contract is. If we get too much money going into this over 7 years of time, then the IRS says, gotcha, we're going to tax you on it. So we want to paste that paid up additions rider so that it produces high cash value without creating a modified endowment contract for someone.
Yes, and if we didn't use that paid up rider, we would have very little cash value because all that base insurance doesn't
It can't
have,
convert
it's
all at
not paid
once.
up insurance, so it doesn't produce cash value initially. And so that paid up rider allows us to start implementing the infinite banking concept much sooner.
Much faster.
So
Yes.
good question, Gilbert. And I know that's a great question, actually, because I've received that question a couple of times just through emails this week, email and phone calls. So thank you.
I would say that's probably one of the biggest questions that we get, although it's not directed so specifically, because people don't understand how the policy is designed, and that's policy design. So many people have come to us with policies they thought were designed, like Nelson Nash says, for a banking policy, and they've bought whole life, but it has no cash value in it.
Yeah.
Or
Or not very much
or not
cash
very
value.
much cash value. So that's really key. So thanks for asking that question.
And another question he has, what is the biggest side-by-side benefit of whole life with PUA? So he's asking about a whole life insurance policy, the base and the paid up additions rider like we're using for infinite banking versus IUL. And that is like two way different things. And that's why I'm glad I'm going to be able to follow up with an email and provide him some resources. A whole life insurance with a PUA, you've got cash, you've got death benefit, you've got cash value that you can use, you have guaranteed values that will last your entire life. Your premium never goes up. And then we have IUL.
So in IUL, the insurance company wanted to split apart the investment part of the contract and pass that on to the policyholder. And they just wanted to keep the fact that if the premiums were paid, they would pay the death benefit. So they were ditching off the investment portion to the policyholder. And so in a IUL policy, there isn't base insurance, there is term insurance. And term insurance never converts to paid up insurance. Never. It's always just term. So what happens is the cost of term insurance always goes up over one's lifetime. And when those term insurance premiums get so costly, especially in the sixth, seventh, and eighth decade of life, they they're very hard to meet. And if the investment portion, which is your responsibility as the policyholder, hasn't performed like it should, then they're going to knock on your door and say, Gilbert, we need, another $20,000 this year to make sure your policy stays in force, or you're out of life insurance.
Mm-hmm.
Now, here's the worst case scenario that I've ever seen. A gentleman bought an IUL policy years ago when they first came out, and he was told that if you put all this money into this policy over this many years, you will
I know this
never,
story. It's
ever have
bad.
to pay premiums again, because look at this interest rate you'll get following these indexes. And so now this fellow is retired and he has not paid any more money in this policy, but he gets a notice from the insurance company, pay this premium or your policy lapses. And if it lapses, all the interest that you earn from following those indexes is going to be considered a tax gain for you on your income. So he was looking at either having to come up with about a $3 million premium payment for 1 year's life insurance,
1 year.
or he was going to end up with a $4.3 million tax liability, because that's how much money had been taken out of that policy's investment portion to pay the premiums that he was told he would never have to pay again in his entire lifetime.
So IUL is a very different thing, and we don't sell it. Back to Gilbert's
But we
question.
rave against it.
Yes, we do. And back to Gilbert's question about how does the PUA affect and show that for how does that work with infinite banking? I love how when you meet with people in a personal strategy session, you create those illustrations right in front of them and explain what's happening and how those numbers work so they can see that. So Gilbert, if you contact us, we'll set up a strategy session for you where you can see what that looks like specifically on your life with your numbers.
Again, we're the tortoise. Whole life insurance is the tortoise versus the hare. This isn't a get rich quick scheme.
Mm-hmm.
The policy is just someplace, as Mr. Nash said, to store your money until you have an opportunity to use it to make more money than what it would without losing the growth on your money. Where when we get involved in IUL, universal life, variable universal life products, now you're mixing insurance with an investment. And you're responsible for the investment. So if you want to invest, that's a good opportunity to invest. But I would say that you would do better without linking it to the life insurance like it happens in universal products, and just keeping your insurance separate, like we encourage people to do, and keeping your investments separate. And that way you don't have that overlap and that sudden liability coming down the road at you when you're probably not going to be able to afford it.
Okay, we have another question from Steve. Steve is also from Arizona. Hey, that's interesting. We had 2 Washingtons, now we have 2 Arizonas. So um, Steve says, hi guys, thanks for doing this Q&A. You're welcome. What is the target client, age, demographics? And is there a hard no due to age or any other factors? So that's an interesting question because the insurance companies often will come visit us and even they say to us, what is your ideal client? So they don't say age demographics so much, they say ideal client. They're often talking about income and some demographics. So you want to answer that?
So the the infinite banking concepts works with anybody that spends money.
There you go.
However, not every person is an ideal client for insurability,
Mm-hmm.
which means that if you've got diabetes, if you're a smoker, if you're overweight, if you jump out of airplanes for a living, if you like to dive in caves, if you like to scuba dive, you're going to pay a lot more for your insurance than someone who never smoked a cigarette in their life, doesn't have diabetes, isn't overweight, because life insurance is sold on our medical risk. It's also sold on our age. So we're finding that people that get up into their 70s, early 70s, probably are not going to be a good candidate for being the insured.
Mm-hmm.
But does that mean that they cannot practice infinite banking? No, because most people in their 70s either have children or grandchildren that they could own policies on and use their children's or grandchildren's policy to practice the same concepts. So it depends.
So
We have to take each case as an individual and design what's going to work for that person. So there is no ideal client.
well, and we've often said our ideal client is someone who wants to take responsibility for their money. They care about the next generation. We're looking more at values, what your values are. Um, and then you mentioned smoking, diabetes. Just because you're a smoker or have diabetes doesn't mean you're not insurable. We can often still get good policies. but you may have to pay a little bit more for that. Again, we do that on a case by case basis. Sometimes the numbers work out and we're good to go. Other times, it
Yeah.
doesn't. And we evaluate that and we'll look at it with you and point out what we see that tells us, yes, it's a go, or no, it's not.
So if someone has one of those conditions or multiple of those conditions, what's going to happen is the insurance company is going to make them pay more for their base insurance.
Mm-hmm.
And that's going to then slow down the base converting to paid up insurance. So there's not going to be as much cash value. And because they paid more for this base, there's going to be less money over here to buy paid up insurance. That's what's happening in the policy. And so it doesn't mean it won't work. It just means that we all pay for the risk category we bring to the insurance pool.
Mm-hmm. All right. Jason from Washington, he has some more questions. He says, we have multiple questions and hope not to dominate. We are going through some major life changes and are trying to make some decisions. Are lump sum policies a good idea? If not, what is the best way to handle lump sums? How has the new legislation affected these policies? Let's see, wait. How has the new legislation affected these policies? Or how do you see them affecting participating whole life policies in the future? Okay. And he's got some more questions after that. So first of all, single premium policies.
Single premium policies are all paid up insurance. There's no base at all in them. And so when you buy that
You pay a
single
premium one
premium
time.
policy, then there is a huge cash value that develops from that. When the cash value in a single premium policy exceeds what you paid for it, the IRS is going to make you pay taxes on the growth if you take a policy loan or if you withdraw money from the policy. So that's more similar to an IRA or a 401k.
Mm-hmm.
All right. They're not bad things, but they're not policies that we practice the infinite banking with. They're just a reservoir to hold money and usually used as a retirement tool to help people pass on more money than what they were able to accumulate in their own lifetime.
In fact, we helped a client with this today. He has a lump sum. He already has multiple whole life policies, and he has a lump sum that he wanted to consider for a single premium policy. So we designed that for him. We also did a comparative to a whole life that he could get at his age using those same funds. We like the single premium better. It gives him greater value, and based on his needs, that may be the policy that works for him.
And I dealt with another client today who just sold his house and has a lot of cash value. They also have some debt,
So
some
that's a
credit card
lump
debt. That's a
sum that they
lump
got.
sum. They got a
Okay.
lump sum. And so what they did is they paid off some debt that they were paying 18 and 21% on before they bought a policy, because it's more important to kill the snakes and dragons when you have the funds to do that. And then I encouraged them to pay themselves back what they had been paying those credit cards.
Mm-hmm.
And that was the premium that they used for their policy.
Mm-hmm.
And, 10 years down the road, they're going to have more money than what they paid the policy. And they're going to have all the money back that they paid the credit cards. Plus, they're going to have a death benefit from the very get go when they pay that first premium
Mm-hmm.
that would more than repay what they paid their credit cards off with.
Mm-hmm. Yes. Um, then also, I'm thinking other things we've done when someone has a lump sum, we have split it out to go into a policy over a series of years. The insurance companies even have an account where they, if you've got 100,000 and only going to use 10,000 a year, they even have an account where they can hold that, give you a little bit of interest. You'll pay tax on that interest, but it's to pay future premiums. So there's ways to look at using that and making sure that we're keeping a policy that's going to be affordable for you even after that lump sum has been used.
Now, some agents will encourage a person with a lump sum to add a term rider onto that base premium so that they then can get extra money over here into the paid up rider. But that term policy does not earn dividends,
That term rider.
that term rider, that term never converts to paid up insurance. So it becomes a drag on this policy. It's not performing to make the policy grows. Its cash values are paid up insurance. So if someone's just going to put that money in there with that term rider and just turn around and borrow out the cash values, they've actually defeated the purpose of the infinite banking concept. Because Nelson Nash said, you want the policy with the least amount of death benefit, and that term rider increases the death benefit to kind of fool the IRS formula about how much paid up insurance you can get into the policy. Nelson also says you want the premium that is most comfortably afforded by the client, the highest that they can afford, and you want to keep the cash values as high. So if you follow all three of those, adding a term rider to a policy to fool the IRS into getting more money into the cash values in year one is actually contrary to what Nelson taught in his textbook.
Yes, and then the other part of his question in this first series, how has the new legislation affected these policies, or how do you see them being affected in the future? Well, one thing we have seen is that the insurance companies have had to change their products, make adjustments because of interest rates or other, well, the first time they had to do that I recall in our 15 years, people were living longer than 100 years. And so they were having to make adjustments because of that. They've had to adjust because of interest rates. And again, because people were living longer. But then once you get a policy, it's guaranteed they can't go back on it. So any other changes you?
So what happened in this latest legislation is that because we've been in such a low interest environment for so long, the federal government said, that the insurance companies didn't have to show as high of guaranteed profit to sell their profits. So what we're seeing is some companies really drastically reduce their guaranteed values in a policy with the expectation that if interest rates rise, they'll be able to pay more dividends because their profits will. But a lot of other companies said, we've been managing so well, that really didn't affect us. We're going to still give our high guarantees. Those are the companies we gravitate because, like my grandma said, a bird in hand is worth two in the bush. We don't
That's
know
right.
what the dividends are going to be in the future.
That's right. Before we go to another question Jason has, I know there's some other people who have questions, and I want to get to another couple that were written in. Suzanne from Utah, she has a policy and she wanted to know, she wanted to move her policy to a trust. I asked her to clarify, did she want the trust to be the owner of the policy or the beneficiary of the policy or both? She wanted it to be the owner. That is just simple. We just send a change form and she can complete it and send the paperwork necessary to get that change made with the insurance company. Whether she should do that or not, that would be a good legal question for what she's trying to accomplish. Sometimes people will ask us, we might have some thoughts, but we're not providing legal advice. And so, if you are making a change, including a trust, you might seek legal advice on that.
In fact, we see a lot of trust being formed right now. It's kind of a fad, especially in different demographics of our country. Seems like different demographics are targeted by these groups that come in and say, oh, if you do what Rockefellers did, build these trusts and everything, you're going to avoid all these taxes and everything. Well, we've run that by our CPAs. One of our CPAs was an IRS auditor for 33 years. He said, you need to look up the abusive trust action that the IRS is implementing on these. Trusts pay the highest tax rates that are out there in the United States, and so you need to be really careful about following these bad things where, oh, if you set up a trust, you can save all these taxes. Just Google the IRS. The IRS will show you what they're looking for. And 9 times out of 10, when people bring us that and they read that form, they go, whoa, all of these things are red flags because this is exactly what this organization is teaching us.
All right. And then Don from North Carolina, he
Hey,
said,
Don, how you doing? Good to see you. Good to hear from you.
He has several questions, and they're all about future, so retirement. So, what is the best way to use policies to retire?
So if we have multiple policies, like we hinted at earlier, maybe I want to leave Michelle and the kids my death benefit on a couple of those policies, or maybe even just one. And I might use the other policies to spin down. I can just withdraw money from those policies. Won't pay a dime of tax until I've withdrawn more than what I've paid. Or I can borrow, and if my dividends are high enough in those policies, the dividends could either offset or help to offset the interest that I would incur from a policy loan. Another option is to use one of our policies that has high cash value in it to buy an annuity. And here's a good thing
Oh, that
about
was
it.
one of his questions.
Here's a good thing about interest rates going up. When interest rates go up, the payment on an annuity is going to be higher because it's based on current interest rates. So that's the real cool thing about the life insurance. The money grows fast in the life insurance policy, but when you're ready to use that as an annuity, you can kind of play the market and see where the interest rates are before converting that to an annuity. That annuity can be guaranteed for your lifetime. So you'll get a payment every month for the rest of your life, or every year if that's how you set it up. And you can put what's called a guaranteed certain period on that annuity, which means that if you don't live for 15 years, if that's a certain period, then your beneficiaries will still get the payments you would have got up till year 15, or you could do year 20, or you can do year 10. You can move that around. So, but the annuities you want to use are not um, are not indexed. They're fixed annuities. They're guaranteed annuities because you don't want at that period in life to risk losing money because of the investments. And indexed annuities behave very similar to indexed universal life policies. You put they put the investment risk back on you, and if all the money disappears because those investments didn't work, that's in your tough luck. Whereas if you buy a fixed guaranteed annuity, then it's the insurance company's responsibility. They signed a contract that they will pay you for that. If they can't fulfill it, the insurance commissioner is going to have another insurance company that is solvent pick up that contract and pay it for you.
Something that's kind of cool about annuities, I don't know if you all know this, but life insurance, it's cheapest when you're young. So you get a better deal to start a policy. You'll pay less for it the younger you are. So you want to purchase that policy as soon as you can. Annuities are different. The older you are, the less time they have left that they will have to pay out on an annuity. So the longer you wait to start an annuity, the better off your payments are. So having money in a life insurance policy and growing it, if you decide, oh, I would rather exchange the death benefit, the cash value in this to purchase income to replace income, then you can wait till you're later, much later in life, and you'll get a better payout on the annuity.
You know, Mr. Nash used to talk about this in a seminar. He said, you know, if you do this real well, and he says, and he always pointed it to me when he was at our seminars, then I would advise Tom to go down and buy an annuity. Now, an annuity can be a deferred annuity too. So if I buy it today when I'm, 61, and I don't start annuitizing that until I'm, in my mid 80s, my payment is going to be huge because it has had time to accumulate all that time as well.
Yeah, because you're not taking the payout until later in life.
That's right. But whenever we take the payment, it's if we buy a guaranteed for life annuity, we will get a payment as long as we live. So if we're healthy and we have longevity in our genes and we don't take payments until our mid 70s or 80s, we might live to be in our late 90s, and the insurance company's life expectancy on us is like 88, 89. Now the insurance company's out of money and we benefit from that.
This is also a good strategy when someone loses a spouse, and we've helped someone with this where they lost their spouse and they have received a death benefit. Um, on the payment of the insurance, and then they have taken that and purchased an annuity on their own life. So now they have a continued income with that death benefit that they received. And the particular client I'm thinking of, he didn't even spend all the death benefit on the annuity. He did some other things and then used it towards the annuity. So it just gives you more options. The more cash value you have, the more options you have. If you have it in different policies, that kind of makes it easier to kind of separate. And then, of course, when a death benefit is paid out, at least spouse with options as well.
So another way an annuity can be used in retirement is if someone has a 401k or an IRA that they've been saving in, and they don't want to be forced uh, to risk that still being in the market, they can roll that 401k balance or IRA balance into an annuity that will be taxed just like the 401k or IRA, but will give them a guaranteed income for the rest of their life without the risk of the volatility of being in the market.
Mm-hmm.
And we've done that with the client, and it was really interesting. It actually increased her monthly income by having the annuity over keeping it in the IRA, but there was zero risk that she would then lose those monies
Yeah.
if the market took a bad turn.
Yeah. That was fun to help her. And Dawn also wants to know, when do you stop paying premiums? Well, whole life insurance policy typically is designed for your whole life, and oftentimes the premium continues for your whole life. However, if you want to stop paying premiums, you can ask for your policy to be reduced. That's a reduced death benefit, and have the premium stop. So it becomes a reduced paid up policy.
So what's being reduced, Michelle?
The death benefit.
It's the base insurance that
Yeah.
hasn't been converted to that paid up insurance. It's just like you kick it out the door. You never have to pay a premium on it anymore because now everything is paid for, because everything's paid up, either because you bought a paid up rider or because the base has converted to paid up insurance. So you can just boot the rest of the base that you don't want to convert. You'll see a reduction in your death benefit by however much base was left, but you'll never have a premium. But the guarantee in the contract is that the death benefit that is left has to match your cash values when the contract matures. So the cash values will keep growing up to that point.
Yeah. So then we could say it's a reduced to paid up insurance.
That's
to
correct.
just the paid up insurance.
That's correct.
Okay, so let's see if we can answer the question from David. And David, where are you? You're in California. All right. In a private family bank being used to pay off debts, where the money paying off their debts is borrowed from multiple life insurance, from a mutual life insurance company out of a non-directed cash value account, I'm running into the problem where the money the client is paying back into the policy after the consumer debt is paid off 3 to 5 years. As you pay that loan back into the policy, it tends to make the policy. What is your solution to this problem? This sounds like this might be an agent asking this question.
But we can answer it anyway.
Yeah, they're.
The problem is your policy is not your bank.
Mm-hmm.
You're thinking of the policy being your bank if you're trying to put all that interest back into the policy loan. The policy loan with the paid up additions rider on it has already maxed out, or really close to maxed out, the allowance that the IRS allows for. So if you're going to put that money back with the extra interest that they were paying on their debts, of course you're going to mech the policy.
Mm-hmm.
That's why you have to set up your own banking system, and we do that by using a separate banking account. That's what Nelson taught us, is that you are the bank, not the life insurance, not your policies.
And that's also where a system of policies can be helpful, or like we set up a money manager account to take care of that money while you're getting yourself in a better financial position. So thank you for that, David. And now we have Robert from New York. I understand that you advocate multiple policies when possible. What percentage of one's investment portfolio do you recommend having in life insurance? In In other words, in comparison to stocks, real estate, or other investments, what percentage do you think should be in life insurance? Well, first of all, we have to say life insurance is not an investment. The Supreme Court ruled it is an asset purchase. And by definition, investments, you can lose everything. And in life insurance, that's not the case. You have guaranteed values. So then to determine what amount should someone have in life insurance, maybe of income or funds that they could use towards investment. I guess that would be the question.
So it goes back to the old donut toy that we played with, our kids played with, the little Fisher
Oh,
Price
the little
donuts,
stack the
the
donuts.
rings.
Uh-huh.
And it's not, it's primarily we want to start with the big ring because that gives us a solid base. And if we
And
relate
that's the
that,
protection that we have. So the insurance that we provide for our family.
the second thing is we want to have some type of savings.
Mm-hmm.
Okay. The third is that we have to manage our debt. Then the fourth ring is that we can invest in things that we're very familiar with and have a pretty good idea that they're going to bring us a profit.
So for a business owner, that might be an investment in our own business. If we have children that, someone wants to buy a car, maybe we're helping finance that. That might be a better investment. We know the situation, we know that child and how they pay back, things like that.
And then the final little ball or the shiny disc on the top, that's the stocks, the things that we're going to
The more
risk.
risky
Because if
investments.
we risk that much, we've got all this down here to do it. But children always go for the shiny one and put it on first. And they get them all stacked up, and then the thing teeters, and boom, everything falls off. Your base, your savings,
Savings, your
you're left with your
protection.
debt, you're
Mm-hmm.
left with your bad investment, and so our good investment, we don't know what it's going to be. So in life insurance, we follow the 10-20-70 principle that was written about in 1933 in George Clason's book, The Richest Men in Babylon. We want people to make an effort to make sure that 10% of what they generate goes toward life insurance. And they may not be able to start there because everyone starts at a different place. Some people have more debt already than other people. Some people already have some savings that they can do more. 20% then of our budget is to manage our debt, because if we don't manage our debt, it will eventually bleed us financially to death. And then finally, we want to use 70% on a new client to make sure that they're living comfortably and within their means. Now, in that living expenses includes your rent or mortgage, your car payment, maybe any student loans you have. It includes paying your taxes, giving to the charities and churches that you want to support. It also includes your food, grocery, clothing, all the entertainment that you want to that you can justify in that
It could
70%.
include your student loan
Your
payments
student loan
to get the
payments.
job that you
Okay.
have.
Now, eventually, it's not going to take 70% for someone to live if they're managing money well. But what this does is allow us then to leverage the 10% in the life insurance to refinance the debt. So instead of paying those creditors interest and losing the principal to a creditor, we are paying the interest back to the insurance company, and the extra interest goes into our banking system, and the principal then restores our credit with the insurance company so we can borrow that money again. So that's a circle. Money is called a currency. It has to circulate under our control if it's going to make us the most profits. Nelson told us the way to do that by using life insurance. Once we get that taken care of, if we need to finance another opportunity, we can do that with the money that's in the policy, or we could finance something over here in our living expenses. Maybe we want to pay off our student loan debt. Maybe we want to pay for the next car. Maybe we want to pay for our next vacation, or maybe we have an opportunity that shows up in our life where we have the ability to make a large return in a short period of time. That's the shiny object on the top of the donut stack. So the 10-20-70 is what guides us in how we set these policies up for people. So, and eventually you will put more than 10% into life insurance, but that's the beginning goal. And most people can't start with 10%.
So starting with 10% of your income, that's our goal initially. And you know, it's interesting because some people think, well, I can't afford that. I don't make a big salary. Well, it's all based on percentage, 10% of your income. And so, time and time again, we've seen that people really can do that.
Yeah.
And then, you know, later on, it becomes how much do they want? If you've got a whole life insurance policy whose cash values are growing and are guaranteed and are there for you to access anytime you need to, your family is growing, you have more needs. Do you want more death benefit? Do you need more cash value? Do you want access to more funds? Are you making more? All those things start playing in. So we don't necessarily have a hard line about what you need. It oftentimes becomes, what do you want?
And
And that's, you know, when we can go from just needs to getting what we want, that's kind of exciting.
so we have to tell Ethan's story here because he's given us permission time and time again to use it because he's just like almost a miracle. Ethan came to us how many years ago? Oh my goodness, it's
10
been
plus?
10 plus
Yeah.
years. And he was actually spending more money than what they were making, which is frequent. We run into that regardless of what someone's making. Parkinson's law, Nelson Nash told us, eats up that money quicker than we can shake a stick at if we don't have a plan for it. So I challenged Ethan. He wanted to buy a policy, but he couldn't afford it. So I said, okay, Ethan, prove to yourself that you're worth 10% of what you're making right now. He goes, well, I'm worth more than that. I said, yeah, absolutely, but you've got to prove to yourself that you're worth at least 10%. So I want you to take 10% out of your paycheck every time you get paid, put it in a little envelope, stick it in your top dresser drawer, wherever you think it's safe, and call me back in 3 months. He did. And this is the answer we always get from people that take that challenge. Oh, Tom, I can't believe how much money I've got in my top dresser drawer. And the cool thing is we didn't even miss it. All right. So now we've helped Ethan get some discipline and prove to himself that he's worth the money he's making. I mean, God tells us in his word that it is the farmer who should be the first to take the produce from his field and harvest. And we need to practice that principle by paying ourselves first. And that 10% belongs to us so that we can do something and grow something even more and more magnificent to advance the causes that we believe in and the values that we hold. So now Ethan was able to transfer that money and start buying a policy with it because he proved to himself he could keep that 10%. Within 6 months, Ethan was able to finance filling up his propane tank completely instead of having to pay the propane truck to come out every week and fill a little bit of his tank up, pay a service charge plus a fuel charge to that truck driver. And that saved him even more money because now he didn't have that fuel charge and he didn't have that service charge every week. And so that money was able to be kept. And eventually, it was shortly thereafter, about 2 years, he told me, Tom, he says, I was able to buy my wife a piece of jewelry that I've always wanted to buy her. I mean, this young guy had 5 kids and had never been able to even splurge something to show his wife his expression of love for her. And then a few years later, he was so excited to tell me that they had enough money that they were able to take their first ever family vacation to Florida and go to Orlando. And of course, now he's bought more policies and his kids are starting to do it as they're grown up. But this is the process that everybody goes through, regardless of how much money they make or where they are at financially when we start working with them.
Yep. And he was a professional. Since then, we've worked with other people, same positions. He was, I don't know, 30s, 40s, late 30s, 40s, but I've seen it happen. People in their 20s, you know, if you don't start the habit of saving, you don't develop it. And we also challenged a young lady to that. Go save for 3 months, come back and tell us, how you did. Well, she needed another month longer because Christmas happened, and then
I just told another client that today.
yeah.
You need to do this because we don't want to put you in something that is going to end up costing you in the future. If you don't have the policy long enough before the cash values overcome the cost of the premiums, then you stop this, you're going to lose money. And that's not something we ever want to get someone involved in.
Yeah. So this young lady, after she finished that extra month of saving, that was several years ago, and she hasn't looked back. She was able to buy a policy after those first few months. So very good. We have another write-in. Sam from Texas is saying, since participating whole life is a stable asset, he got asset, that appreciates steadily over time with little volatility, would you ever consider doing premium financing to acquire additional participating whole life policies?
We have considered that. Um, I have done premium financing to buy life insurance. But it actually put me in a financial bind to do that. We borrowed money against equity out of our house, our last home, and we bought life insurance with it. But now um, we have that line of credit or that loan, that premium finance interest to pay. So if it does not produce as much as what the insurance policy is producing, and it doesn't over the first 10 or 15 years, then I've got to come up with that interest out of my own pocket. Then if I borrow against that insurance policy to use and what I use the money on doesn't return the rate of return I was expecting it to, guess who has to make up that interest? So we have been in very low interest rates since 2000, 2001. If it doesn't make sense to premium finance in those low interest rates when we looked at it, as interest rates rise, I see that becoming more and more improbable for the math ever to work out on that, Sam.
Um, and you have looked at premium financing several times over the years. Even I know just even recently in the last year or so, you looked at premium finance because a lot of insurance agents will recommend that or push that. Even the insurance companies talk about premium financing and how wonderful it could be, or here's where you could get a good deal for premium financing.
Sells policies.
Yeah, there you go. But whenever we start really looking at the numbers, it's just not adding up. So until we see numbers adding up for that possibility, well, we'll let you know. But until that time, we would say, no, we don't really recommend that. It's just going to cost you more money.
Now,
Um,
what we do recommend sometimes is if you can use your policy as collateral with a bank that is going to give you a lower interest rate than, say, 3.5% when your policy is going to charge you 5%, it's probably going to be a go. But we still have to do the math because remember, the growth in the policy could offset the lower interest rate that you're getting. So we always have to look at that. All right.
see what the numbers are. Okay. Oh, we have just gone over an hour. I do see that we have just a few more questions here. Um, should we take another question?
Let's go ahead, and if people need to leave, we understand, and if not, we'll get it recorded, and if this recording turns out, then it'll be available there.
Yeah, and if you're having a good time, be sure to send us an email and say, hey, do this again, or would you consider doing this again? If not, well, that's all right. Okay, so let's see. We have a question here. How are the insurance companies viewing COVID-19 and the vaccinated versus the unvaccinated? Are they factoring these in? Oh, I'm glad you asked that. Again, this is from Jason in Washington. This is a hot topic. So let's see, the big rumor went around that insurance companies will not pay if someone dies of COVID.
Or if
Um,
they've had the vaccination, that
or
one's
if
going
they've
around
had
too.
the vaccination and died of COVID. And so let's see, it was a little over a year ago, especially. Oh, this has been a long time. So January 2021, it went around social media. That was a big thing. We contacted the insurance companies and we asked if they had seen any of that. And I talked to the underwriter and they said, no, I don't know where these got started, but that is not true. So we do not have any COVID questions on the application.
Other than the fact that if you've had it, you have to wait 30 days before
60 days.
60 days.
If you've had COVID, you have to wait till you're symptom free for 60 days before you apply. But that's not really different than other things on the application. If you've had surgery, sometimes you have to wait a while before you apply. And then sometimes they require a good health statement at the time the policy is delivered. So, you're signing final documents and paying. Sometimes they have you answer questions. Have you had, COVID in the last 60 days? And so you would have to sign that. Or have you had any symptoms of COVID in, this certain period of time? So you might have to sign that. But, and if you said no, and then you died of COVID within, a short period of time, then they can contest that and they have to pay your premium back to your family. That just makes sense. That's like normal life insurance. So are we seeing anything with COVID-19, anything out of the ordinary? No, we are not. We did process a few claims of deaths that happened due to COVID. They were processed in a very timely manner, no extra questions asked. Are they second part of that, are they factoring COVID in? I'm sure they have to factor those things in underwriting, but remember, insurance companies have been around for a long time. They are used to factoring in all kinds of things. The Spanish flu happened years ago. They have to factor those things in.
And let's put that in perspective here for just a second.
Sure.
Okay. The Spanish flu killed less people than COVID, but it killed more of the population. Up to 50%,
because the population was smaller.
Up to 50% of the population living when the flu epidemic went through in the 1918, the Spanish flu, it killed up to 50% of the population. We haven't even overcome 5% with COVID. And as they're revising COVID deaths, it's even less than what they told us was in the first place. So yes, the insurance companies always look, they understand that pandemics happen. More people, die of tuberculosis in a 5-year period of time than have died of COVID over these last 2 years. So we need to put it in perspective. We need to realize that there's always rumors. We have to understand that the CEO, who used to be the chief financial officer of one of the major insurance companies we represent, wrote me a personal letter when I asked him this. And he said, yes, we are seeing an increase in the death rate, but we expect this to happen. This is something that happens systematically, very frequently. We just don't know what time period. So that has already been figured in, just like the Spanish flu was already figured in. It didn't make any insurance company go bankrupt or insolvent and when the flu system didn't make any of them go through in 1958 when that flu system, or 1982, or all the flu system. Or to put this in perspective, like I began to say, he said, this rise in mortality is not going to cost us even a third of what the 9/11 incident did when terrorists hit New York City.
Yeah, and that was another one of those factors. The actuaries don't know when there's going to be a terrorist attack,
They
but
just know they're going to happen.
they have
just
to
don't know when.
figure in those certain things.
Yeah.
And then the other part of the question, are they factoring these in? I'm assuming you might be thinking about vaccinations. We've heard of, we all hear about the increased heart incidences that are happening with young people even who have been vaccinated. If that trend continues and the insurance companies are seeing that becomes a factor that they need to look at, then future policies underwriting, there will be further underwriting around the heart issues. Whatever develops in a population that they have to consider, they will make adjustments for that.
So something that's very interesting, that most of this increase in death is happening with people that are insured in group policies, not in individually held policies.
Oh yeah, that's interesting
This is
too.
really fascinating because Group policies, the liability for that falls on employers. So every year or 18 months, the premiums on group insurance are adjusted, and the employers of whoever that group is with has to make up those premium difference. So as these these mortality rates go up, as they're seeing happen, then that's going to be adjusted, and it's not going to change the premium on your existing policy. It's going to change the premiums on group policies that are being paid by employers or groups that have bought policies together. And it might change the premiums on future policies that are bought, but not unless the insurance company sees that's necessary.
All right, so I'm pleased to report that we got to all the questions that were emailed to us ahead of time, and we got to most of your questions. I see that I still missed a few from Jason, so I'll be following up with an email, but Jason says, hey, do this again, so I know he's not too upset. I didn't see any hands raised, so I want to thank you for joining us. I will be following up with emails, and if you would like to have a strategy session or call us to discuss some of your particular questions, maybe that you didn't put in, or that maybe this session's brought some other questions to your mind, let us know. We're always glad to hear from you. And again, please let us know, did you like this? Would you like to do it again? Anything else, Tom?
No, just thanks for taking the time out of your day to join us, and hopefully other people's questions stimulated thoughts in your mind, and hopefully all your questions were answered to your satisfaction. And thank you for asking them, because there's always someone else that learned because you asked your question.
So thank you very much. Have a great evening.